Okay, last time we were talking about a little bit of this history of banking, and part of the history of banking gets into the idea of regulation. If you remember, we talked about the McFadden Act. What year? 1927. That was the year Babe hit 60. This is what officially broke our country up into making basically banking markets at the state level or smaller, and what gave us thousands of different banks. We talked about that a little bit, how that this prevents banks from achieving economies of scale. Large-scale operations sometimes are more efficient, lower cost than smaller-scale operations. So to achieve economies of scale, bigger banks would be better. And that's not about everything, but it is some activities. And it also prevents banks from enjoying what? Geographic diversification. You know, when I talk, I cannot spell. That is to say, diversifying risk into various geographic areas. Okay. I believe where we stopped last time is talking about the Glass-Steagall Act. Which was enacted what year? 1933. What had happened was this. The Great Depression started in 1929, but really started off as not such a terrible thing. It was a recession, and then it just got worse and worse and worse. And what happened during this period, 29 to 33, was about 1/3 of all banks failed. Okay, and there was not a lot of regulation. There was not a lot of data collection. There was not a lot of economic analysis. And so basically what happened, I mentioned to you last time, is people just kind of made up their own story on what happened. And so one story that was very popular then was, you know, these banks failed because they were reckless and sometimes fraudulent and, you know, just dishonest and just a bunch of bad characters, and so we've got to regulate them. And so, and there are undoubtedly bad characters in any group, except for college professors. But almost any occupation, almost any career, you're going to find some people that are breaking rules. But the point that I think most economic historians looking back would today say, you know, that was not mainly the problem. We have seen this same type of situation occur at various times. What happened here, and what knocks 1/3 of the banks out, or any large number of banks, is basically a panic that sets in when people are worried about, hey, are my deposits safe? I think we all know this, that when you put money in the bank, you make a deposit, they don't just throw all that money in the vault, lock it up, you know, put a guard on it, and wait for you to come get it. What they will do is take most of that money and make a loan. And they're holding fractional reserves. So most of us know that when we give our money to the bank, they just hold a little, and most of it's gone. And so what happens as a result of those fractional reserves is when banks start failing, and you get, it's not just any small bank, but you get kind of a large bank to fail, and then people that are doing business at other banks think, gosh, I hope my bank doesn't fail because they're just holding some fraction. Most people don't know the fraction, but just some fraction of my money is actually being held by the bank. If they close their doors, I won't get my money back. And so that's what happened during this period, was a few notable banks failed, and then just a panic set in. And so people then said, you know, as far as I know, my bank's not doing anything wrong, but I ought to go down just to be safe rather than sorry, I'll get my money back. And so if banks are holding 10% of our deposits on reserve, and 11% of us get the idea, I'm going to go get my money back, we go down there, we get in line, we ask for our money, the bank's taking the money out of the vault and paying everybody what they owe, and finally they get to the end of the cash, and then they say, sorry, we had no more. And that's what happened back in 1930, 31, 32, 33, is banks would just say, sorry, I have no more. And it wasn't because they were fraudulent, it's because of fractional reserves. Okay, and it doesn't make any difference if you had 50% fractional reserve, if 51% of the people show up. And I mean, if you have a bank that is managed perfectly, does not take any significant risks at all. Nevertheless, if people show up and they want their money back and you have fractional reserves, you run out of cash. Now, in theory, and we don't want to get too far talking about the Federal Reserve because we'll talk about it later, but in theory, the Federal Reserve is set up to stop that. That if people go down to the bank and say, I want my money, the banker could call up the Federal Reserve and say, hey, our customers want a lot of cash. I want to borrow some from you. And the Federal Reserve, in theory, will put a bunch of cash in an armored truck and drive it out and say, here you go. The only problem was the Federal Reserve wasn't playing along. It wasn't doing its job in 1930, 31, 32, 33. And so when those bankers called, the Federal Reserve says, this will blow over. Well, it didn't. It blew over. The banks failed. What do we have today? Well, we'll come back to it, but part of Glass-Steagall. I told you about the part of preventing banks from getting into other activities, but part of Glass-Steagall was deposit insurance. And so today we say, oh, if my bank fails, I'll still get my money. Anyway, back to our story. So there was this idea going around at 1933 and later, well, before 1933 actually, but the idea was going around that these banks are failing because they were mismanaged, because they were taking improper risks, because sometimes they were crooks just managing the banks. Okay? And so that idea was there, as I say, without a lot of good reason. And so then what happened was you got a new president elected. Who was the president? Anybody? 1932, Great Depression, new president, Franklin Roosevelt. Thanks to those of you who don't study your history. 1932, Franklin Roosevelt's elected. He takes office in 1933. And within just, 100 days or something like this, maybe you remember reading about this, but they basically passed one new law after another, this whole New Deal legislation. And they created Social Security and did a lot of other things in a short period of time. One of the things they did in that short period of time is they, quote, fixed the problem with banks. And part of that was deposit insurance. And part of it was to erect something that has been called a firewall around the banking system. And the firewall is basically this. We've got our banks here. And I don't mean to say a bank, but just banks. And then the idea of the firewall is we're just going to create a wall around banks and just say, look, if you want to be a bank, be a bank. If you want to do something else, for example, insurance, or something else, I mean, any number of different activities. If you want to manufacture cars, if you want to do something else that's not banking, you just go do that something else, but don't do banking. Those are different businesses. And so here's the firewall. And so the term I used last time was, I said that Glass-Steagall said that these banks could only engage in activities that are closely related to banking. And in those days, closely related to banking mainly meant taking in deposits and making loans. Okay, and also maybe buying some government bonds and things like this. But anyway, taking in deposits and making loans. And if you want to do these other things, I just mentioned insurance. But investment banking, brokerage, boy, a long list of activities. The answer is no. Okay? The problem with this is what? Banks can achieve diversification. Before we were talking about geographic diversification. Now this is product diversification. Right? What, you go to the Walmart store, you see all the different things they sell. What if all Walmart could sell would be just, pick something out like toys. And then if there's a downturn in the toy business, Walmart would be in financial trouble. But Walmart instead has all these different departments, and so if there's a downturn in toy sales, maybe something positive is happening over in the automotive department or over in the groceries department or someplace else, cosmetics, right? Well, what we're saying to banks is you just do this one thing and then that's it. And if there's a downturn in that one thing, then gosh, that could be something that imposes a lot of risks on that banking company. Another thing, they can't achieve economies of scope. Before we talked about economies of scale. Economies of scale are efficiencies that occur when you get bigger. Okay? And that was a problem of the McFadden Act. Economies of scope are economies or efficiencies that you achieve by having operations in related activities, but not the same activity. Okay, and one of these may be, for example, marketing. Another may be analysis. What you have is insurance companies, investment banks, they're conducting a similar type of analysis. Wouldn't it be nice if you could hire some accountants and economists and different financial experts and so forth and let them analyze issues for you, financial issues, and then share that information within the company? And there would be economies that you would achieve or efficiencies if you could have one economist or financial expert or accountant and share this knowledge with different lines of business. Well, we're saying, no, you can't do that. If you want that analysis, you hire that person. If you want the analysis, you hire the person. Potentially, we're paying twice as much. What about, it could be that the same people, the same customers, I'll use the same little picture here, maybe the same customer wants to buy insurance as wants to do banking business. Wouldn't it be a convenient thing if you go into this customer comes into the bank, says, hey, I want to do a little business today, and the banker says, hey, do you need insurance for your business? Or if this person goes to buy insurance and they're signing up for insurance, casualty insurance, businesses have to buy insurance on their buildings and things like this. Hey, you're buying insurance. Do you need a business loan? Because we've got a bank. Well, you can't do that. You just go do business with an insurance company, go do business with a bank. Those are separate activities. There's no cross-marketing of these products. Okay. So anyway, it's the economies of scope that this works against. We won't allow banks to achieve these savings, these economies of scope. Okay? So, what? We didn't get diversification, we didn't get economies of scale because of the McFadden Act. We didn't get diversification, we don't get economies of scope because of Glass-Steagall. Okay. So, that's kind of the situation that we faced up to 1933. 1927, 1933, we get these laws. Let's talk about history post-World War II. By the way, the economy changed a lot between 1933 and post-World War II, 1946, along in there, late 40s, early 50s. And I don't know how it occurs to you in your own mind, but really we're talking about a period that's not so long. If we just say from 1933 to 46, 13 years. If we say 1933 to 53, 20 years. And I know 20 years is a long time compared to the age of a college student, but it's not so long. It's not forever. And so here we are at the very bottom of the Great Depression. A lot of people out of work. It's an industrial economy, but the economy is not operating on that scale. We get into World War II, crank up all this really heavy manufacturing. We're making airplanes and ships in huge numbers, supplying the world, I shouldn't say the world, but everybody who's our allies with a lot of food and clothing and things like this. the war is over, and a very good part of Europe and a very good part of Asia, a big part of Europe and Asia, are just bombed out. And so their industrial base is gone. The war's no longer going on, but the United States still has this really powerful economy, and people around the world, if they want manufactured goods, if they want sort of advanced products, they came here, right? And I mean, we were dominant in the world economy. So we go from a situation where, boy, the economy is not doing much until early 1950s, just preeminent in every way. By the way, we had had the leading economy in the world for a long, long time. But here it's just dominant. It's like there was not any competition anymore, because here's Europe and here's these major Asian cities and so forth just been bombed into oblivion. People just living in poverty. And so now it's not a close competition. I don't know. We weren't measuring a lot of those numbers at those times. I wouldn't be surprised if half of the gross domestic product of the world wasn't being produced in the United States. And today it's more like 20-25%. So anyway, we've got this really advanced industrial economy after World War II. And so these things are getting in the way. McFadden Act, Glass-Steagall Act, they're getting in the way of what bankers want to do. Now what's happening is there's all sorts of prosperity in the United States. Population's growing rapidly. We know about the baby boom generation. Started in 1946. So the population's growing rapidly. There's just houses being built every place. Big businesses, small businesses everywhere. The banking industry is wanting to grow along with the economy. And here we have McFadden Act and the Glass-Steagall Act, and that says no. And so bankers are saying, what are we going to do to get around this? Because that's what they do not do is say, oh, that's what the law says. Okay. What they say is, that's what the law says. We have to obey the law. But is there some way of obeying the law and still getting what we want? And what they're looking for is a loophole. Where is there a loophole? Is there a way to get around these rules? And so, let's talk about this one, the McFadden Act issues, this no branching. There's a bank holding company movement. I mentioned this already, bank holding company. The law says this: banks cannot branch across state borders. And a lot of states said you can't even branch within your county. That would be a unit banking state. Or you can just have a few branches, limited branching states. What are we going to do about this? Well, here's what happened. At first we had a bank. And maybe out here are some shareholders that own it. Not maybe, but for sure, that own that bank. And so let's develop a new kind of company. And the company wasn't, this idea didn't come up after World War II. The idea was around before, but didn't expand much. And so after World War II, hey, here's a really good application of the bank holding company idea. We'll set up a bank holding company. We'll tell these shareholders they don't own the bank, they own the bank holding company. And then the bank holding company owns the bank. Okay. For example, here's Commerce Bank. It was a banking company in Kansas City. And so they set up a company in also Kansas City, Commerce Bank Shares. And Commerce Bank Shares is a bank holding company, also Kansas City. Okay? And so, now what? Now what is they say, hey, state laws don't allow us to open branches around the state, us banks, but they don't prevent bank holding companies from owning separate banks. So let's go over and have a bank in St. Louis. Let's have another bank in, I don't know, Joplin. And you just go down the list. And they had way over 100 banks in Missouri. Is this legal? Yeah, because the law says you cannot have branches around the state. You're limited to how many, a home office and how many branch offices. And by the way, each one of these could have, it depends on the year we look, 2 or 3 branches. But that's it, and you can't open branches in the next county over or 100 miles away or anything like that. Okay, we'll open banks, separate banks. Each one will get its own charter, its own license to operate. And this will be called Commerce Bank of Kansas City, Commerce Bank of St. Louis, Commerce Bank of Joplin, Commerce Bank of Springfield, Commerce Bank of Columbia, and so forth. Separate banking companies. And then what they said is this, hey, if we need to train new employees, what we can do is we'll hire some tellers, and maybe this bank will get a teller, this one will get 2, this one will get 3, and then we'll train them all at the same time and achieve some economies of larger scale business. We'll get a computer and provide computer services to 100 banks in the state. We'll make a commercial, and the commercial will be the same, and we'll show it all over the state. And then all they'll change on the commercial is it'll say Commerce Bank, you know, and some slogan and some picture and some generic kind of a building. And then all they'll do is say Commerce Bank and then add the words of Joplin, of Columbia, of whatever. But it's all the same commercial. And so what they're doing is they're finding ways to achieve these economies of scale and yet comply with state law. I think Commerce Bank was late to do this, but there were some other banks that were actually jumping over. There was a Boatman's Bank in St. Louis, and Boatman's Bank jumped over the state border into Illinois. Okay, and they got around the McFadden Act very clearly by going into Illinois. Was that legal? It was not legal for Boatman's Bank to do that, but the bank holding company that owned Boatman's could do it and acquire a bank over in Illinois and other states. And so this is a bank holding company movement. What happened? Let me do a little erasing here. What happened? Well, we got the Bank Holding Company Act of 1956. And it said, you know, up until now, it didn't say exactly these words, but up until now, bank holding companies are just formed and do whatever they do. But now we're going to start regulating bank holding companies. Before you can start up, what is a bank holding company? It's a company that owns a bank. By the way, this is really just a shell operation. This bank holding company is not doing anything. It's just a legal entity. Its function is to own a bank. Okay, so anyway, what they said is if you want to set up a bank holding company, you've got to register with the Federal Reserve and you've got to comply with the rules the Federal Reserve has for bank holding companies. And the first thing that you cannot do is get around the McFadden Act by having a bank holding company. No bank holding companies jumping over those state borders. Okay, but bank holding companies are still very popular, and where they were most popular was, this is after 1956, they were most popular in states with unit banking and limited branching, because in states with unit banking, limited branching, we still have these laws that prevent branching or limit branching, and how do you get around that? Bank holding company. By the way, this act gave the Federal Reserve a whole new role, and that is the Federal Reserve is the regulator of bank holding companies, and still is today. Okay, so the Federal Reserve is a bank regulator of member banks, so-called member banks, and the Federal Reserve makes monetary policy and does a lot of other things, but it also regulates bank holding companies since this time. So anyway, this was taking place starting in the 1950s. 1980s, we got another movement, the Nonbank Bank. I think I maybe mentioned that the other day. Here's what happened. Banks went to the Federal Reserve that was regulating bank holding companies, and said, what do you mean exactly by a bank? and you're all going to see this someday because you'll have kids, and the kids will come in and ask you some question. You'll just think, that's kind of a curious question. I wonder what that means. That means that kid's getting ready to fool you, okay? What do you mean I can't go on the other side of that street? And then you'll say, don't go over there. Okay, no, I didn't go to the other side. I just got out halfway into it. That sort of stuff. Anyway, so the banks go to the Federal Reserve as the regulator of bank holding companies, and they say, what do you mean by a bank? And the Federal Reserve said, it's a company that accepts demand deposits and makes commercial loans. And the bank said, oh, that's right. I'd forgotten what you meant by that. And then what they did is some of them got rid of demand deposits. They just said, we'll take your savings account, but no more checking deposits. No. And other banks kept taking savings and checking deposits and stopped making commercial loans. But then they said, we're not banks. Because a bank, the Federal Reserve said what a bank is. They accept demand deposits, make commercial loans. We don't do those two things. Yes, we accept demand deposits. We don't make commercial loans. Or yes, we make commercial loans, and we don't accept demand deposits, just savings deposits. We're not a bank. Never mind that they had bank charters. We're not a bank. So, since we're not a bank, let's jump into that next state. So then, like a Florida bank would jump over into Georgia, say, look at us. It's like, I'm over here. I'm in Georgia. I'm not a bank. You can't stop me. And the Federal Reserve say, stop it. This went on for 2-3 years. And the Federal Reserve got very upset about this. They're getting away with murder. And so then the Federal Reserve went to the Congress and said, pass a moratorium. And the Congress said, okay. And they passed a moratorium. And they said, that's the end of that. And the banker said, boy, we had something going there for a while. Okay. In 1982, there was something called the Garn-St. Germain Act. Here's what was taking place. There was a savings and loan crisis at this point, and the banking industry is going through tough times too. By the way, we had 2 recessions, one in 1980, and that one in 1980 just ended very quickly when the Federal Reserve started throwing money into the economy. And then we went back into the recession in 81. So there were 2 recessions, one in 1980 and then another one, 81, 82. And they were so close together, it looked like one bad recession. And so what happened was in 80 through 82, banks were not doing well. The number of failures was up, but there was an actual crisis in the savings and loan industry. And so lots of banks, lots of savings and loans were failing. I mean, not dozens, but hundreds and hundreds of savings and loans were failing. And so the government was running an insurance plan, not only for banks, but another one for savings and loans. For banks, we had the FDIC, and for savings and loans, FSLIC. And so a lot of banks, a lot of savings and loans failing, and these insurance funds are being depleted. And so what the Congress did, and there was more to the law than the Garn-St. Germain Act, by the way, named after 2 people, a senator and a congressman. This congressman, in my opinion, was a bad man for reasons that we won't go into here. But I mean, it was all about his performance of his job and so forth. Anyway, Senate Finance Committee, House Banking Committee, chairpersons. And so very often that's how these laws get named, McFadden, Glass-Steagall, and so forth. So anyway, what this law did was they tried to say, how could we save some money for these insurance funds? And then what they said is this: if we have a bank or a savings and loan and it is failing, it's about ready to go under, and we know that we're going to be over here into this insurance fund to deal with this problem, pay off depositors and so forth. If we've got a bank or a savings and loan that's failing, before we close it down and pay them off, what we will do is we'll turn to the rest of the banking industry and say, hey, if you want to buy this bank or savings and loan that's failing, we'll let you do that, even if you're crossing the borders of state borders. Even in, it's not violation anymore because they changed the law, but in violation of the original McFadden Act, we will let you cross those borders if you will take on this obligation of the federal government, of the FDIC, FSLIC. Yes, sir.
Would they like auction them off?
They would auction them off. They would first say, who's interested? Maybe 5 banks, 10 banks would say, I'm interested. And then what they do is bring these bankers in, let them see the books, and basically let them bid. We don't want to get into this too much right now, but when a bank is failing, it's got some bad assets. And so usually what will happen is the government will, FDIC will step in and buy some of these bad assets at face value, and so then get rid of those bad assets and then sell the bank off to somebody else. In this case, that didn't happen though. We've got a bank, it's failing, and I mean it's lousy, it's got a negative net worth, maybe by a lot. And then we say, this is the federal government, we say this, you know, we've always told these bankers they can't cross the border from, let's say, New York into California. But we get this billion-dollar problem. And so what we'll let you do is we'll let you break that rule and cross the border from New York into California if you'll take this billion-dollar problem off our hands. And so that's what Garden St. Germain did. Okay? And so the banks that wanted to expand their network into other states, not all banks wanted to do that. But there were some banks that wanted to basically develop an interstate banking network. And so when a bank would be failing, they'd get the news of that, and then they'd go out and make an attempt to buy that bank. And like I say, they were solving the government's problems. It's understandable, but it's a little bit like, you know, paying the government protection or something like that too. It's kind of like they say to you, you may not do something unless you pay us a lot. And so the banks were, basically the healthy banks were paying for the privilege of entering these states. And so we got some interstate banking that way. A third way that we got interstate banking, also in the 80s and early 90s, we'd call these regional banking pacts or agreements. The McFadden Act said this. It said that nationally chartered banks had to follow the same rule as state chartered banks. And always before, a state would just regulate banking within their state. But with one of these regional banking pacts, what would happen is 2 states that are next to each other might get together and say, hey, your banks can come into our state if our banks can come into your state. And so this would be reciprocal agreements. It was almost always done on a regional basis. So this became regional reciprocal interstate banking. And almost always it's with states that are immediate neighbors. So then with contiguous states. Contiguous would be touching states. And that's the way these tended to develop. Let me draw you a little map of the United States, and I am quite a little map maker. Several lakes up north. Florida is putting on a little weight, a little bulk. So what we got was something like this. We got a region in the southeast. We get a region in the northeast. By the way, what they're trying to do is cut out New York and some of these, like California, where these biggest banks are, what they're basically trying to say is, we don't really have a problem with Georgia banks getting into Florida or Florida banks getting into Georgia. We're afraid for our Florida banks and our Georgia banks if those New York banks come in here and compete with us, because they are huge. And they'll just take all our customers away and put us out of business. We can't have that. And so these regions started sprouting up that were excluding some of the states with the biggest banks. And so there's this New England region, and there was a Southeast region. There was a Southwest region. I shouldn't get California in there, but a Southwest region. And we got a Midwest region. And guess what? There were some banks in the Southeast region, and their region included, like Tennessee, and then Tennessee was not only in the Southeast region, it was contiguous to states in the Southeast, but also contiguous to states in the Midwest. And so you could be in Florida, in theory, and then get yourself a bank up in Tennessee, and then get yourself a bank in Missouri, and then one in Oklahoma, and then Oklahoma is in the Southwest region, and then you're into Texas, and then you're into, Arizona and New Mexico, and you could be doing pretty good. So what happened was we got a lot of interstate banking at this point, but it was done on a regional basis. And so we got these not huge banks out of this, but pretty big. And so we got to a certain point where we just said, we're not very far from interstate banking. And so in 1994, we got something called the Roegleneal Act. Regal, Senate, Neal, House of Representatives. And so then what it allowed basically was this. It didn't allow, there's two different kinds of branches. There's, branching by merger, and then de novo, which is new. Just go out and open a branch. And so what Roegleneal said is, we will allow mergers, not de novo branches. But so we're not going to allow like a New York bank to come into your state or my state or whatever. We're not going to allow New York to come in there and just open a bunch of branches. But if a bank that is otherwise well capitalized, well managed, doesn't have financial problems and so forth, if they are complying with all the regulations, we will allow them to merge or to acquire banks in other states and turn that bank into a branch office. And so if they want to be in, I don't know, you name it, Montana or someplace like that, they can go out and basically buy a Montana bank, and then now we've got a branch office in Montana. I don't know where the hell Montana is. It's up there someplace. North, a lot of trees. Buffalo, I think. Big sky. Anyway, questions about this? And that is basically where we are right now, is we have got now banks that are huge. I think I mentioned to you Bank of America. And Bank of America is in 40, I'm going to say 42 states, but maybe that is not current, but something like that. Do you remember how many branches I said? It's 6,300 or something like this. Does anybody remember that number? Oh, I don't think it was 7,000 anything. 6,000. I'm going to say 3. Did you have it in your notes? 6,200? I was very close. And so they are scattered all around the United States. Not every state, but in a lot of states. Yes, sir.
Can you explain what the non-bank was again?
The non-bank bank. You said non-bank. It's non-bank bank. Come on. That'll hurt you on a test. The banks were prohibited from jumping over state borders. So then they went to the Federal Reserve and said, what do you mean by a bank? And they got a definition. It's a company, accepts demand deposits, makes commercial loans. And then these institutions said, thank you. They didn't say what they were up to. Thank you. And then they went and either got rid of checking deposits, stop accepting those and tell their customers, take your money back. Or they stopped making commercial loans and sold those commercial loans off. So they either do not have checking deposits on their books or they don't have commercial loans on their books. And then, according to the definition of a bank, they were not a bank. And then they said, hey, the McFadden Act, that applies to banks. The bank holding company, that applies to banks. We're not a bank. So then they started jumping over those state borders. What I'm saying to you, though, is they still had bank charters. So they're a bank. They're just not a bank, a non-bank bank. So anyway, that's kind of the history, what's happened with this whole McFadden Act and the branching. And today, we have got banks that are doing business in thousands of different locations. And this is the way it seems to be going. There are big market shares. One aspect of this Roegleneal Act, I almost said it the other way around, is to limit market shares. And so one thing they did is they said, we don't want our banking companies to get too big. And so they put a limit then on 10% of the market share of the bank. That is for the United States. We don't want a bank being bigger than accepting more than 10% of all the deposits going into banks in the United States. Okay? And so at the very least, there would be 10 banks. And of course, we still have thousands, over 7,000. So anyway, let's go on with a little bit of history and talk about how the Glass-Steagall Act has worked out. I won't talk too much about what I did a moment ago, which is after World War II was over, the economy was very vibrant, the stock market was strong and so forth, people investing from around the world, people more prosperous, they're buying insurance, they want a whole range of financial services. And so, anyway, we've got the firewall of Glass-Steagall. And so then, bankers said, hey, I got an idea. And this idea is not very unique. I'm going to set up a bank holding company. And that bank holding company owns a bank. But then it's also got this subsidiary that does something else that's not banking. Let me give you a little bit of this. What we talked about already, the bank holding company, this is a multi-bank bank holding company. The multi-bank bank holding company, its purpose is to get around the McFadden Act. This is still a single bank bank holding company. Its purpose is not to get around the McFadden Act. Its purpose is to get around Glass-Steagall. That is to say, to comply with the law and yet achieve those objectives of getting into other businesses. Okay, and so after this movement got going for a while, we got the Bank Holding Company Act of 1970. We already had one in 1956, and the Bank Holding Company Act of 1970 then told the Federal Reserve, it's not just the multi-bank bank holding companies, but the single bank bank holding companies. We want you to regulate what these subsidiaries are doing. Yes, sir. I don't know about the grandfather clause on this. They were grandfathered with the multi-bank bank holding companies. I don't know. From other things, I mean, I don't have the answer, but from other things I do know, my guess would be is that they gave them some time to divest themselves of these or to come into compliance. Because as soon as the Federal Reserve started regulating what these subsidiaries can do, and they were called subs, but as soon as the Federal Reserve started regulating this, the first thing they did is they came out with a list and they said, here are activities that are closely related to banking, closely enough that we will allow you to do it. And so then these banks would have to come into compliance with the law with their subsidiaries. And let me finish by saying this. I told you economic historians were not really buying into that story of what caused the Great Depression. And so economists are the ones running the Federal Reserve, and economists are the ones regulating these banks. And so economists were pretty much willing to add more and more functions to this list of what subsidiaries were allowed to do. And this list went from a few things to more and more and more, until finally it was a pretty long list. And whatever was on the list, a bank could just do it and didn't even, I mean, they had to apply, they had to register, but they didn't have to wonder about, gosh, is this going to be allowed? The answer is going to be sure. And like I say, more and more and more. And there were dozens of different activities that bankers could get into by the 1990s. We'll talk more about this next time. So long.